third quarter earnings season gets into full swing. But will earnings be enough to justify the market's multiple and keep this year's rally going? Let's ask PIMCO's Erin Browne, who joins me now. Erin, it's great to see you. It seems as if we've reached this moment where a soft landing both seems likely and also very much believed and priced in. So where does that leave you in terms of the markets?
Well, we've been talking about this since the beginning of the year, that in the second half we were going to see a broadening out of the breadth of the equity market and see leadership not just from the Magnificent Seven, but for the remaining 493 companies. And you're finally starting to see that over the last couple of weeks. You've seen the Russell outperforming. You've seen the S&P equal weighted index outperforming the S&P. All of this is a sign of a healthy market. And then when you layer on top of that the setup going into the third quarter earnings season, the bar is pretty low. Going into earnings, the bar was for 3% year-on-year earnings. That's a pretty big step down from the second quarter, where we grew 11% on a year-on-year basis. Earnings are sort of eking up as we start, to see positive earnings surprise. But both the fundamental and the technical picture look pretty good into year end. That said, going into the November election, I do expect a bout of volatility, particularly around the election. That's not a reason to stay out of the market altogether, because as we know, it's policy, not politics, which drive the equity market. But I do think that you have to keep some dry powder waiting for opportunities to get in when you see any type of volatility or drawdown in the market. So remain slightly overweight, looking for opportunities to add more risk, but really focused on a broadening out of sector rotation beyond just what's worked in the mega cap space over the last 18 months or so.
Yeah, it has been really evident even in the last couple of days. You've had not much going on at the index level or even some weakness, but it seems like 3/4 of all stocks are up, and you do have that kind of cyclical tone to leadership. So, that checks off a lot of the boxes. I guess I'd wonder, if we do get a bout of volatility, what in particular would you look to pounce on?
So the sectors that we still like AI. Now, tech, as you've seen with ASML earnings over the last 24 hours, there's a pretty big bifurcation between the haves and the have-nots in tech. I still think that the AI names will work. You've gotten a little bit of weakness in some of those names over the last few trading sessions. I think that that's really opportunistically a good time to start to buy back some of those names. I also really like the REITs. One of the sectors that, is going to be pretty flat on a year-on-year basis by the end of the year has been the REIT sector, just because of higher interest rate costs eating into earnings. But I think that as we move into 2025, as we continue to see REITs come down, I think that's going to be a sector that's going to do, quite well over the next 12 months or so. So we're really focused on buying the REITs. We also like the power AI names. There's been a lot of volatility since the summer in some of these names, but I still think the independent power producers are really primed to do very well next year as we see rate resets and as we continue to see the AI build out really increase power usage across the U.S.
Erin, how are you thinking about the moves in China, both on the policy side and then the way the markets so radically, sort of repriced for them and now have been correcting off those highs?
So China, I think, still remains a challenge insofar that we really need to see policy and fiscal policy that's meaningful in order to buy China as an investor as opposed to just a renter. We bought options in the China market that took advantage of, sort of cheap optionality to the upside. It's no longer cheap anymore, although it's certainly come back a little bit in recent days. But I think to get, long-term bullish China, I still need to see a lot more in terms of rectifying the challenges that they're having on the housing, having more consumption-oriented fiscal spend, and really solving some of the structural problems that have plagued China over the last 24 months.
Erin, we started out by talking about how, everything does seem to be coming up, softish landing, just a benign backdrop, and maybe the Fed looks like it's gotten things right. But it wasn't really long ago. It's really just a couple of months ago where it was seen as the labor market's eroding too fast. We've gone through these kind of hot and cold kind of perceptions over the course of this year a bunch of times. Do you think there's a risk that we're just have, the next growth scare is right around the corner, or is it going to be a overheating scare or something like that?
I mean, certainly the sort of boogeyman for the equity market remains out there. Inflation, starting to pick back up again. Right now, all of the trends that we're looking at, whether it's, housing costs or renting costs, some of the import inflation and the data that we saw over the last 24 hours from PPI earlier in the week, and then import data this, more recently, is all suggesting that inflation is on a downward trajectory. We do think it's going to remain stickier as we get, further, closer into 2025. But, energy costs coming down does help. I think that the risk is if we were to see, a real revamp of fiscal packages coming out after the election, that could potentially lead to higher inflation in late 2025 into 2026. But for now, we feel very comfortable that the Fed still has a green light to continue to cut rates, given the fact that inflation, we think, will be cooperative, certainly over the next 6 months or so.